First, I'll cover investment management part and then I'll cover wealth management part. Okay. Both are here. Both are so similar that many of you will find that what is this going on? Is it investment or wealth? Because here, understand the logic. Investment management is a part of your wealth management. Kindly note, investment management, this is a part of, see, complete wealth management is full big topic. In this small part is investment management. So after all, it will lie within this only. Okay. So follow completely. Follow till the end, all of them. Okay. So let's move on. Okay. Today, what is investment management? Investment management is basically a process of making decisions about investment. Simple. What is investment management? Thinking about investment. Now, decisions about investment means what? What do you mean by this word decisions? Now, these decisions can be, these decisions. It means what? Decisions about investment. Means I can decide on myself. I want to keep my money at around 4%, 5% returns per annum. Or do I want to give it for 15% returns? With studies, scientific studies. Here, you can make the returns when you have scientific studies. You give patience. It's like the studying for your JAIIB, studying for your CIB. You require time, isn't it? So without time, can you clear JAIIB, CIB? Just like that only, by fluke. One subject you can clear, but not all. Same thing is about investment. Once or twice, if you try and if you buy luck, you can get it double in 1 month, 2 months. Many stocks are there. You might be hearing many of the guys telling you that invest in this stocks. Tips, right? You hear the tips, everyone? Tips. इसमें इन्वेस्ट कर ले, 1 महीने में डबल हो जाएगा, डबल. Then in 1 महीने में double, your principal is also gone. Everything is gone. That friend is gone. The one who gave the tip, gone. Or sometimes what happens? That friend who gave the tip is again there. नहीं हुआ क्या? अच्छा, you didn't get the money. कोई problem नहीं. Take the second one. इसमें तो हो ही जाएगा. पूरा loss निकल जाएगा. Whatever you have lost, everything you'll get it back. Does it happen? Then this also gone. Everything requires time, patience, studies. So decision about your investments, how to see whether you are making investment or whether you are throwing the whole money in the sea. It depends on you. Investing in schemes which give you double is like throwing the money in the sea. No use. Okay. You hear na daily that SEBI and you call anyone, you'll get that. अगर किसी का call आए, double करना, ये करना, kindly न माने. What is all that? That is because people are getting becoming a prey to these schemes. Ultimately, it's the greed of everyone. It involves researching, selecting, and monitoring a portfolio of assets that match an investor's goals, risk profile, and time frames. Means here, researching, very important, researching, selecting, and monitoring. 3 words are very important. Research means you find out which is the best investment, which stock, which bond, which real estate will give you better returns. Selecting means deciding on something. Here, selecting means taking action, deciding on something. And monitoring a portfolio, monitor the portfolio. Monitoring means whenever, here, this is also one important part, what I see generally. We make the investment and then we forget. Invested, bus, ho gaya abhi. It's not that. It's a continuous cycle. You know the bicycle? How do we ride the bicycle? We have to do 2 things. One, keep pedal, right? So that it moves. And second, hold the direction also, handle. If any of these things goes wrong, if you don't hold the handle properly, then also you fell down. If you don't pedal, then also you fell down. Both the things have to be done simultaneously. Investment is like that. You have to carry on the daily working also, and you have to look at the long-term goal also. Okay? So, researching, selecting, and monitoring a portfolio of assets that match an investor's goals, risk profile and time frames. Investors' goals, risk profile and time frames. Kindly understand, everything is here. Banking is very easy. Only the point is, we make it difficult or our books make it difficult. Same thing is investment is easy. Only the technical persons or the so-called knowledgeable persons make it difficult. So many big things are given. Beta, delta, gamma, 1000 Greeks are given. We don't understand anything. Then we say, "Arey, kuch nahi samajhta, chhod do." Right? Management, investments are always easy. Only you have to follow your own gut feeling, and number two, follow the patience. Patience is very important. Don't expect untoward results or untoward profits. Expecting a return of around 10 to 15% in a year in equities is okay. In mutual funds, I will call it. In FDs, you get around 7 to 8%. So you should beat your FDs. Okay? The basic rule is you must beat inflation plus GDP figure. Very simple answer I'll give you. Inflation plus GDP. If you beat these two figures, total, then you have won. Inflation plus GDP. You have to beat that figure. Okay? So this is the golden rule which I am giving you. Kindly remember, how much returns do you expect in any investment? The golden rule, you will not get it anywhere. This I got it from one of the MDs of one of the banks, big banks, biggest bank I would say. He gave this principle that your investment should give you the returns of GDP plus your inflation. Then you have won. So expect sober returns. Okay. So researching, selecting and monitoring a portfolio of assets that match an investor's goals, risk profile and time frame. Risk profile means what? Am I ready to take the risk? High risk instruments. Am I ready to invest in equities? Right? Am I ready to invest in only bonds? Am I ready to invest only in this liquid funds which don't cause any harm to the principal, but returns are also low? See, there are basically three rules. Okay, one is equity. See this. If you invest in equity, you will get high returns, high risk, high returns. Then you invest in bonds, you get medium risk, medium returns. Bonds. And last one is T-bills, or you can call it government bonds, government bills, okay? Then you will get lowest risk, lowest returns. So logic is simple in investment. Kindly note, high risk, high returns, high risk, high return. Okay, this is the basic logic of investment. High risk, high return. So what we must always try, we must not try for this high risk, high returns. We must try for medium risk and medium returns. This is what we must always try. We shouldn't try even for lower risk, low returns. At least at the age of your young age. When you are old, 70 plus, then it's okay. Low risk, low returns. Saving the principal. But when you are young, up to the age of, I would say 50, 55, 60, you must try for medium risk, medium returns. So this is what when we talk of this risk profile of that customer, depends on the age of that customer. Generally, above 70, 65, 70, the person becomes risk averse. And time frame, how much time frame does this customer have? Okay, or is this customer going to give for the investments? There are many persons you might be seeing, invest today and from tomorrow they start tracking the share value. I invested in Infosys. Immediately from today, tomorrow, अरे नीचे गया, अरे ऊपर गया, बेच दो. Give some time. You are not a trader, you are an investor. Investment management encompasses a wide range of investment opportunities for individuals and institutions looking to grow their wealth, from stocks, bonds to real estate to other assets. Means basically it includes not only your stocks, not only your bonds, but real estate also. real estate. Okay, this can also be one strategy. There is a fund called as REITs fund, REITs, REITs funds. This is similar to mutual funds, but these REITs funds invests in real estate, in various flats, in various shops. From there it gets the rent and then it pays to the investor. This is the REITs fund, similar to that of the mutual funds. But MF invests in equity or debt depending on the fund, right? And REITs invest in real estate. Got it? So, basically it is all the four. Kindly note, it is all the four. Okay? Stocks also, bonds also, real estate also, and other asset classes also. What are other asset classes? Other means there are many unconventional assets, like some cars. Many of the persons have the liking for some cars, antique pieces. They give any amount for that antique pieces. So that is also an investment. There are certain paintings. People purchase the paintings for 100 crores. You and me can't, right? So it depends on other asset classes. These are other asset classes. Investment management objectives. Here, main objective of any investment is only two: generate high returns or moderate returns and minimize the risk. We must always try to get the lowest risk. Now, lowest is not possible, but get a medium risk. Medium risk and medium returns. This should be the strategy followed by us. Okay? Other than this, there are various other objectives. Assess and manage the risk. Manage the risk. Manage means managing. See here, many times what happens, we invest and then we say invested. अब मैंने रिलायंस का शेयर ले लिया, बहुत बड़ी कंपनी है. मैंने इन्फोसिस का शेयर ले लिया, बहुत बड़ी कंपनी. It's very big company. SBI I have purchased. HDFC Bank I have purchased. Good company. Don't do that. Managing is very important because companies are good, but the share value goes up and down. You have to see to it that you buy at the lower rate and sell at a higher rate. Not only about the shares. I am talking about overall investment. Anywhere you buy a flat, whenever you feel you are getting a better returns, you can sell it off, because that's also an investment avenue. Bonds, same thing. Okay, so assess and manage the risk. Investment managers must assess the amount of risk they are willing to take and how to manage it on an ongoing basis. Ongoing. Managing means monitoring. Ongoing. Okay, managing means monitoring. Simple. Then establish goals. You must set the realistic goals. Realistic goals means what? You must tell your client that expect return of around 15%. The formula I gave in the golden rule, GDP plus your inflation. Expect a return which will beat these two together. An investment manager will help you determine your financial objectives and create strategy to reach them. Here, strategy is very important. Otherwise, what will happen? If wishes were horses, beggars would ride. Right? It's the saying, no? If wishes were horses, beggars would ride. But if you follow a strategy, if you work on it, then things become easier, isn't it? They'll become easier. So that's why follow the strategy, not just establish the goals. Try to reach your goals. If you think, I'll clear JAIIB, just say, I'll clear JAIIB and do nothing. Why are you watching this YT, this YouTube series right now? Why have you joined the paid classes? Because you want to clear. That is strategy. Work on it. Okay? Same logic. Select investments. Selecting the investment means when you have a deep understanding, with a deep understanding of different asset classes, the manager will choose the appropriate investment for the investor's needs. Again, important word is needs. What does that customer require? Needs. If that customer requires high returns, this investment manager can select risky instruments. A bit risky, not completely risky. That is not allowed. If the client is totally risk averse, this client doesn't want any risk in the life. In such cases, the bond funds will be selected or the government dated securities will be selected. We call it gilt funds, gilt. Okay, they'll be selected. These are issued by government. These are the dated securities. They'll never lose money. Whenever you invest in any government fund or government bond, you will never lose principal. You'll earn less, but you'll never lose principal. Okay. So, depending on the investor's needs, investor's goals, you have to select the asset. Okay. Monitor the progress. Monitor means continuously watching it. The manager will track the market conditions and adjust the portfolio accordingly to maximize returns while mitigating the risk. Mitigating means reducing the risk. See, reducing the risk or you can't remove the risk. See, somebody says that I completely remove the risk. Not possible. In any instrument, it's not possible. Because in government also, suppose if you say government principal is saved, that's okay. But the government should be performing. There is also a government in Congo. There is also a government in Pakistan. Will you invest in their bonds, Pakistan bonds? You know, principal will also go. You know, Congo, North Korea. Will you invest in the bonds of that government? So government is also you can trust, but depending on the credit of that government, the rating of that government. We as a Bharat right now, we are in among the first 5 nations in the world. We are moving towards the third one now. In next year, by I think so 25-26, we will be third. Okay. So, in that case, you have to monitor the progress. Which funds are you investing? In which instruments are you investing? Market conditions. Here, basically, you can invest in either equity, mutual funds, means generally for personal level, I am telling you. You can invest in equity mutual funds or your debt funds or your this liquid funds. But if you are in the younger age, I would always suggest you invest in equity mutual funds and give some longer time. Always invest through SIP. SIP is the best investment tool. SIP is something, mutual fund sahi hai, they call it na, SIP sahi hai. SIP will give you huge returns in the longer run. Kindly note, longer run. Okay. Mitigating the risk when necessary. Mitigating the risk means reducing. Now the mitigating the risk can be, this instruments can be, mitigation of risk can go from smaller normal mitigation techniques like investing in FDs, or it can go to higher mitigation techniques like derivatives. Derivative is also a mitigating factor. It can reduce your risks. Kindly note, derivative can also reduce the risk. In fact, it is for reducing the risk. Derivatives are purchased for reducing the risk. This strategy you will see in wealth management, wealth investment. If you are long on any position, always try to buy put option in derivatives, commodity derivatives. Okay, if you are long on any position, long in on shares, let's say commodity means shares. Let's say you are long on shares. Long means what? You have purchased now, then you will be selling later when the price goes up. That is called as long. If you are long on shares, buy the put option in derivatives. Put option in derivatives. And reverse is also true. Short on shares is not possible. I won't tell you that now because we all are in JAIIB. So we won't go for short on shares. But kindly remember this strategy. Hedging, mitigating the risk is hedging the risk, reducing the risk. Okay. How does investment management work? Establish investment goals. Investment goals already we have discussed. Investment goals means what? Establishing, knowing where you have to go. Then establish a plan. Plan means strategy. Now many things will be repeated in investment management because logic is only one. Reduce the risk and maximize the risk, maximize the returns. This is a basic strategy followed in any investment. Uncover and choose your investments. Okay, these two ones you have done, goals you have done. Selecting the goals you have done, establishing the plan, a plan you have done. Now uncover and choose your investments. Now once you decide on the plan, then decide on the investments. It's time for action. Don't just think. Okay? It's time for action. After deciding your strategy, you'll need to research and most suitable investments for your portfolio. So you select the most suitable shares. Not only shares. Here, why am I talking of only shares? It can be shares, it can be FD, it can be real estate, it can be anything. Okay? It can be PMS. You are having the topic of PMS also in investment management, portfolio management services. That can also be there. Okay? Track your portfolio, rebalance your portfolio. Very important. Here, only investing and then forgetting it. It's not fill it, forget it, like the petrol. There was an ad earlier in 2000, Suzuki Samurai, that bike. They used to say, fill it, shut it, forget it. Fill the petrol, shut it, forget it. Move on. But forget it means what? You have to check whether the petrol is there always. If I just shut it, forget it, then it won't go for infinity, right? It won't go for infinity. This bike won't run for infinity on the same petrol. I have to constantly keep a track whether the petrol is there in the bike or not. So that is the same logic over here. You have to constantly keep on checking whether wherever you have invested, is it giving you the returns? If it's not giving, then rebalance your portfolio, rebalance, change it. Okay? Your money is important. Share is not important, or any investment is not important. If something is not giving you returns, immediately change it. Okay? Now we'll come to some questions. Let's do some questions. Now it's your time to answer. Match the different financial stages. I'll be giving you 4 financial stages. So match the different financial stages. Accumulation stage. Accumulation means what? I go on accumulating. Generally it is in the age of 25 to 35, roughly, in that phase. Up to 35 generally. Accumulation. So which one is correct in this? The stage is more concerned with maintaining existing growth than achieving new heights. Okay? So this stage is more concerned about achieving, right? Maintaining existing growth. Is it accumulation? When one can go for bold investments and set aside a fixed amount for investments and premiums. Bold investments. I can go for the risky ones. Bold means risky. For bold means risky. During this phase, the efforts one has to put in over the years, to build a retirement fund and other investments will finally pay off. Is this related to retirement? Now you answer, is it 1, 2 or 3? Think over it, everyone. Yes? The answer is, which one is the answer in this? The answer is, one can go for bold investments. This second, accumulation, you are in the young age. You are in the age of around up to 35. So you can go for bold investments. Okay? Now second one. The maximum amount allowed to invest in SGB. SGB means what? Sovereign gold bonds. Government has brought in new bonds. New means what? They are old ones now. Instead of investing in real gold, physical gold, government says invest in gold bonds, so that physical gold need not be imported by the individual. Here, physical sovereign gold bonds are based on gold only, physical gold only. But this gold is with the government, with the RBI. So these are sovereign gold bonds. It is based on gold only. When I say 1 gram of sovereign gold bonds, when I buy, it means I am having 1 gram of gold. Government will give me equivalent amount of money if I go to sell it to the government. Okay. So how much amount or how much sovereign gold bond am I allowed to invest as an individual? Suppose if I want to buy sovereign gold bonds, how much amount or how much kg am I allowed? Is it 4 kg, 25 kg, 2 kg, 20 kg for individuals and HUF? Individual and HUF. Now this you have to answer. Think, check on Google. Think. What is it, everyone? What is the answer? Maximum amount allowed to invest in SGB, sovereign gold bonds, for individuals and HUF. It is? It is? Yes. Here, for individuals, it is 4 kg. Okay, 4 kg. I'll mark this over here. 4 kg. Individuals, it is 4 kg. Individuals and HUF. Okay. If it's a charitable trust, a big, like we have this in a year, and everything is for a year. This is for a year. 4 kg in a year. Kindly note, year. It's for a year. Kindly note. If it is a charitable organization, like we have temples, various Balaji temples and others, or many others charitable trusts, they can invest up to 20 kg. But here the answer is 4 kg. Don't mix this up. That is for charitable trust. Okay? This is for individual. Individual is 4 kg. You are allowed to invest. Okay? Among the below mentioned formula, which one is correct? Explaining the wealth management. Now this investment management, wealth management can be interchanged to one another. That's why these questions come over here also. You'll see this. See this wealth management and investment management. There's a relationship between them. In fact, investment is a part of the wealth. Wealth management is a bigger topic and investment management is one of the part of it. Okay? So this is wealth. Let's say this is wealth management and this is investment. Investment. And this is wealth. Okay? This is how it works. Okay? So, wealth management equals to investment consultancy minus advanced planning plus relationship management. Minus, second one, wealth equals to investment consulting plus advanced planning plus minus relationship. Third one, investment consulting plus advanced planning plus relationship. All this is plus and minus game. This plus this minus this plus this minus. Investment consulting minus advanced planning minus relationship management. So what is the answer in this? Very simple one. What is the answer? Yes. Answer is simple over here. It is all plus. Everything is plus. Wealth management includes your investment management. Okay. Investment also, plus your advanced planning also, plus your relationship also. Relationship with the client. This. You have to always maintain a good relationship with the client also, in your family also. Simple. Here. One basic rule of investment I'll tell you. Keep your head cool. Barf. Keep ice on your head and keep sugar on your tongue. Keep ice on your head. It's always said, ice, sir pe baraf, ice on head. Okay, ice on head and sugar in mouth, sugar on tongue, sugar on tongue. Okay, this is the rule to be followed always, not only in investment, in your life also. सिर पे बर्फ, मुंह में शक्कर, sugar on head, ice on head and sugar on your tongue. Then life is simple. Okay. So the answer is this: relationship. What do you mean by relationship management? It is the same thing. Your client scolds you. Your client will say you have done a mistake. This, that. When you do good things, then the client will say, okay, you are like the God. You have to be stable in both the cases. Okay, so the answer is C. Okay, next one.